Welcome to Sense and Sensibility, the Inflation Guy podcast. I'm Mike Ashton, the Inflation Guy. I am your host. And you know, I ask every time I do one of these podcasts, roughly weekly, I say like that if you have a thought and you want to write to me, you can write to me at inflationguy@enduringinvestments.com. And I try to respond to all of those. And sometimes listeners write and they say, gee, I'd really like to hear about X. And sometimes I can answer the question quickly, and sometimes it's not necessarily a great topic for a podcast per se. But recently a listener asked me to address the long-term effects of inflation at 4% compared to 2%, which when you first hear that sounds like, well, that's not that big a deal. It's just 2%. But it turns out that even something small like that, or what sounds small, it's actually quite large, can have an impact on lots of areas of our society, of markets, of our lives. And so I'm going to talk about the effect on institutions, budgets, investing, household decisions, how people approach economic decisions generally, how businesses approach them. It's taken me a while to get there, to put this podcast together compared to when this listener first wrote to me. So I hope he's still listening. But that's what we're going to talk about today. And of course, I always have to thank our sponsors. This episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies perfect for diversifying your equity and bond portfolios, previously only available to big institutions and the ultra-rich. Check out their website at simplify.us. That's simplify.us. Their entire lineup of ETFs is available at simplify.us/ETFs. And before I get into today's big topic, I first want to have a quick side note here. So most of what I'm going to say today is sort of timeless. This episode, you can refer to it in 5 years. It'll age well because I'm talking about big picture effects. But kind of nearer term, there's a question in the market about whether the Fed is going to ease again. The Fed last year in 2024 started off with a 50 basis point eased another 25 basis points. And the question going into 2025 with inflation still high and looking in some ways like it's going to hook higher, will the Fed tighten in 2025 or will it ease in 2025? And some Fed officials recently, as in this week, have made some comments that sounded like, they're considering easing even at the upcoming meeting, but definitely could ease over the course of this year. And I just want to say one thing about that, and that is that there is no economic reason right now for the Fed to ease. Inflation is higher than its target, and growth is sufficient. Growth does not look like it's falling off a cliff. I've long since expected that it would, but it doesn't look like it is going to. If it does, then the Fed can go ahead and address it. But in the meantime, there's really no reason for the Fed to be thinking about an ease. But there's one good reason why they might consider it, and that's cover your ass. Because the Fed, when they kicked off this easing cycle with a 50 basis point shock and all kind of ease, which is extremely rare for them to start an easing campaign that way if there isn't a calamity happening. There was only one reason for that, and it was immediately obvious that the main reason was political, that they had a preferred candidate outcome, and they wanted to support the current administration. Well, what was then the current administration. And that was obvious. And they followed it up with a 25 basis point ease because the 50 basis points would be a little bit too obvious if it was by itself, and they had to sort of follow through and say, no, there's a lot of reason to ease here. And so they followed it up, but with just 25 basis points because already the opportunity or the reasoning for why any ease at all was necessary was already starting to weaken. And so now here we are, and then they skipped a meeting. We're sitting here, and the question is, are they, should they ease again, or will they ease again? And the only reason that you would ease now is that having eased in what was a nakedly political move to go and support the administration, by easing now during the Trump administration, you can argue that no, see, we weren't trying to help anybody in particular. We just really think there's a good reason to ease, and so you're trading off the perception of a political stance for the perception of incompetence, but because there is no reason to ease, but that is probably preferable to the Fed. And the reason that's probably preferable to the Fed to just appear incompetent as opposed to political is that the quid pro quo for decades between Congress and the Fed has been, Fed, if you just focus on the economy and you're not political, then we'll let you be independent. And so as long as you just stay out of politics, you just do, and so the Fed for decades worked very hard to not look political, to not ease or tighten around an election, if they could avoid it, and to not say anything overtly political, and to not take positions other than big economic positions about spending, congressional spending and deficits and stuff like that, other than to say, hey, we don't like deficits and so on, but not to make particular political statements. And that was the quid pro quo, that, Fed, you want independence, then stay independent. And you do your thing, you stay in your lane, we'll stay in our lane. If it's perceived, and it already is perceived in a lot of quarters, that the Fed is becoming political or has become political, then their independence is at risk as well. And so the Fed would right now much prefer to just be viewed as incompetent than to be viewed as political, because if they're viewed as political, then the Eccles building could be a lot smaller with a lot fewer economists in a very short period of time. Anyway, so that's what I have to say about the coming Fed meetings. Would not surprise me to see the Fed ease, even though there's no economic reason to do so. But let's talk about the long-term effects of inflation, because that's the part of this podcast that has a shelf life. The long-term effects of inflation at 4% versus 2%. Now, the important part about long-term is that there's actually a couple of different things that are important about that. One, of course, is the compounding thing. Compounding effects get large at long horizons. 4% versus 2% is not a big deal over the course of a month, or a course of a month or a year. But if you're looking 10 years out, the price level of inflation is at 2%, is 22% higher than today. And if the price level is, if inflation is 4%, isn't just double that, 44, it's 48% higher. At 20 years, 2% compounds into 49% increase in the price level, while 4% compounds into 119%. And so the further out you go, even small differences compound into very, very large differences. That's one of the reasons, by the way, as an aside, that we know that CPI can't be dramatically wrong. Everybody feels like inflation is actually higher. Certain shysters have made careers saying that the CPI, dramatically understates inflation, but we know that can't be true. That is dramatically wrong, because over a long period of time, you couldn't miss the effects. They'd be really, really, really large. So, but there's so much more to the question of 4 versus 2 than the simple mathematical answer. 4% is double 2%, but it's only a 2% difference. So how can it make much of a difference? And the way to get to the answer to that question, I think, starts by considering a world with no inflation. Okay, all prices are the same day after day. All wages are the same day after day. In that kind of world, in the world where all prices are fixed, then the dollar would be more than just a store of value. It would directly represent value in terms of the struggle that was required to earn it. So if I get paid $1 an hour, then $1 represents exactly 1 hour's worth of work, no matter when I earned that dollar. It's worth 1 hour's worth of work. And what I can buy with $1 is just what I can have if I work for 1 hour. Okay, so I can that $1 meal menu at McDonald's is the 1 hour work meal menu, regardless of when I do that 1 hour of work. Then that means that savings and planning start to get really easy if that's the case. If I have 40 hours of work per week times 50 weeks times 45 years of labor, my lifetime endowment is about $90,000. 40 times 50 times 45. And so I could, in principle, decide on my first day of work what my plan is. What do I want to buy, when, what do I want to save, straight on through retirement. I kind of know that in my life I will make $90,000. And so I could plan out for the next 45 years exactly what I want to buy. Now, some uncertainties never go away, like when will I die? And therefore, how long do I need to plan to be smearing that $90,000 over? But that's the case for insurance or Social Security or something like that, to take the mortality risk or the longevity risk away from me. And also, even in a world with no inflation, there's still a cost of time. That is, by deferring my consumption, I should earn interest so that I can spend more in the future. Everybody, all else being equal, prefers consumption today to consumption tomorrow. I would gladly pay you Tuesday for a hamburger today. But that cost of deferring, or that benefit to deferring consumption, would just be a real interest rate reflecting the true cost of money, and not a nominal interest rate, which also includes the compensation for the fact that when you're busy delaying consumption, the dollar is also buying less over time because prices change. In this zero inflation world, that's unnecessary. So there'd be only real interest rates. Then the savings or spending decision for you is just comparing your own discount rate to what the market offers. That is, would I rather consume that hamburger today or 2 hamburgers in 10 years, if that's the real interest rate? And that becomes a direct trade-off. I know exactly how many hamburgers I can afford in 10 years because it's only the cost of money that's involved. And I can look at my preferences, my discount, what I want, and compare it to what's available. And so without inflation, all of those prices, or all of those consumption decisions, I should say, are tied together simply by real interest rates and your own preference curves. That menu of possibilities is only limited by what real interest rates are that connect today to the future. Relative prices never change because prices never change. The only thing that changes is how much you can get by deferring consumption into the future. Okay, and I can add a little bit more texture to that if I want to sort of risk future consumption. Right, I can defer my consumption and get a better future consumption, but it's riskier by having a risky discount rate. Okay, so that instead of buying a real bond from the government that guarantees that I'll be able to consume 2 hamburgers in the future as opposed to 1 hamburger today, I can buy that same bond. I can buy it from Cousin Vinny, and Cousin Vinny will give me 4 hamburgers instead of 1. But Cousin Vinny's a little sketchy, and so I'm taking some risks. So I can take those risks, but I know, but one of the risks that I don't have to take is that the price of that hamburger is going to change. So all my trade-offs are very, very clear. I can get more consumption in the future by delaying, and I can, or by taking more risk. Okay. So investors in this no inflation case, okay, so that's sort of the consumer position, but investors in this no inflation case also get this neat benefit that they enjoy inversely correlated stock and bond markets. And I've talked about this before, because in this world, inflation is not a driver of changes in yield. We know that the main effect in those yields, those real yields, is the business cycle. When the economy is weakening, bond yields will fall as the demand for money goes down, because this is just a demand for money. The demand for money goes down and real yields fall, and that makes bond prices go up. But the weakening economy means stock prices will go down. When the economy is strengthening, the demand for money goes up, bond yields will rise, and therefore bonds go down, but stocks are doing better because the economy is strengthening. That is why at low inflation rates, stocks and bonds are inversely correlated. That's great for the investor. It increases portfolio efficiency because portfolios have more natural risk diversification as a result of that. Businesses in this zero inflation case, like the consumers, can plan for the long term. A business can have a 10-year fixed price contract with its suppliers and with its customers. And both sides, in this case, benefit from the stability of the supply chain. In an inflationary environment, you can't do that because even if the value of the product doesn't change appreciably, in real terms, the cost to provide it may change. If inflation goes up more than expected, the supplier under a fixed price contract is screwed because the supplier is providing fixed prices which are lower compared to what other people will pay today. If inflation goes up less than expected or is negative, then the buyer is screwed by paying too high a price compared to what is available today. And so in an inflationary environment, if you move away from zero inflation, the risks of taking on a long-term contract go up. Similarly, if I'm a business, I can hold less inventory in a zero inflation environment and therefore use less capital. One of the reasons that businesses hold inventory in inflationary times is because they can make more money by buying inventory at today's prices and then selling the inventory at tomorrow's prices. But if there's no inflation, that's not a reason to hold inventory. The capital structure of a business, it's how much of a business is supported by debt and how much is supported by equity. Over time, if you're a big company, that capital structure drifts. If nothing happens, the value of your equity goes up, the value of your debt doesn't. And so over time, a company that does not re-enter the capital markets will gradually move away from sort of an optimal capital structure and get more equity heavy and less debt heavy. If you have no inflation, then that happens at a much slower rate because the value of those bonds that you've issued don't deteriorate with inflation. A business can take on long-term projects without as much variance in the possible long-term nominal returns. If you're going and calculating the net present value of a project, you know exactly what the price you're going to be selling your product in the future is because it's the same price as today. On the employee side, I know my merit raise each year is really a merit raise. I know it's rewarding my improved contribution and skills. There's no more merit raises, in quotes, merit raises of 2% when inflation is 4%. Bob, we're giving you a merit raise of 2%, but inflation was 4%. Isn't that a pay cut? Yes, it is. There'll be no more having employers slow roll the cost of living adjustment. Last year inflation was 8%, and so we're going to give you an 8%, cost of living adjustment, and we're going to give it to you in June. The longer they take to add to my paycheck, the more they make and the less I make. And so now if we have no inflation, we can simply argue about whether I added more to the business this year than I added last year, or whether my skills are in greater demand this year than last year. And I don't have to try to get ahead of inflation by asking for a bigger bump in my salary than I deserve on the basis of what I'm doing today. I don't have to try to get ahead of inflation because the inflation, may accelerate later this year. And so in that way, it's the same as what I was talking about before with fixed price contracts with suppliers. Both the supplier and the demander of labor can deal with one less pressure point, which is that they are no longer on opposite sides of the inflation bet. This will tend to mean weaker labor unions in a no inflation environment, as there's less need for collective bargaining to defend powerless workers against being abused by inflation adjustments. The correlation between labor participation and inflation historically is quite high. Labor unions were very strong in the early 80s. They weakened in the couple of decades from the mid 80s on, and they've started strengthening in recent years again. And that's true in countries with lots of inflation. Unions and labor actions tend to be much more common. If there was no inflation, a lot of the reason, not all of the reason, but one big important reason for labor unions goes away. Government and taxes. Well, the tax burden would actually go up if we got rid of inflation, the explicit tax burden. That's because inflation itself is a tax. It's how the government increases revenues without having to do anything. Milton Friedman said it many, many years ago, and it's absolutely right. The government has to get its money one way or the other. And if it's got X expenditure, they can tax it from you, or they can let inflation increase its government revenues because the government taxes gains on securities and other property when those gains are only reflect inflation. If you buy a stock today at 100 and there's 10% inflation and you sell it again at 110, well, you didn't really make any money. Prices went up 10%. The price of your item went up 10%, but guess what? You owe tax on 10%. That is an inflation tax, very explicitly. In a lot of ways, in fact, inflation is a tax. It's not a slogan, but it's a real phenomenon, and it's a very regressive tax as well. So without inflation, if the government wants to increase their services, they have to increase actual taxes. If inflation went away tomorrow, government would probably have to increase its explicit taxes because it could not expect the actual taxes, the inflation taxes to go up year after year. And that would probably mean smaller government, because if the government had to actually explicitly tax you for what they were going to spend, it would be harder. Now, everything I just said about 0% inflation is still mostly true if inflation is 0.1%. Okay, it's still mostly true if inflation is 0.5%. But it becomes less true as inflation goes higher. And so that's, of course, the big question about what is price stability. Volcker and Greenspan wanted inflation between 0 and 1%. And they explicitly wanted that because they thought that at that level, inflation wouldn't have a large impact on business decisions. It could be mostly ignored. Other economists wanted 2% because it gave them more room for action if bad things happened. But the point is that whether it's 0, 1, 2, economists want inflation low enough that you don't have to think about it. And 2% is at least close to where you don't have to think about it. We know that because for 2 decades, nobody did think about it. So what happens now if you have to think about it? If inflation is now 4% and you have to think about it? Well, now as a consumer, my consumption choices have to take into account not only how much it means to me to have that hamburger now compared to deferring it, I also have to consider how much more is that hamburger going to cost in the future when I go to buy it. So I demand more of compensation in order to delay consumption. Interest rates have to not only include the cost of money, okay, that what I get paid to defer consumption, but they also have to include a chunk to compensate me for the expected higher price of hamburgers in the future. And there's risk on both sides to future prices, which means that all else equal, I'll be less willing to delay that consumption as long as I otherwise would. And the person who wants hamburgers now will be less willing to pay me to defer it for a long time. Because if we both assume inflation is going to be 6, but it actually comes in at 2 or comes in 12, then one of the two of us got screwed in that deal. So the bondholder not only has risk to changes in the cost of money, but also has risk to changes in the inflation rate. So bonds and everything else becomes riskier. All of these deals, all of these agreements become riskier. Not only do individual securities become riskier for the investor, but the overall portfolio loses the risk savings from diversification. Stocks and bonds previously, in my previous example with zero inflation, they moved inversely because the ebb and flow of economic growth affected them differently, but that was the only effect. Now, in an inflationary environment, 4% inflation, now when inflation goes up, it's bad for both stocks and bonds. And when inflation goes down, it's good for both stocks and bonds. So stocks and bonds now tend to move together. And historically, it's about 3.5% is where stocks and bonds become correlated as opposed to inversely correlated. That's one sign anyway of what level, at what level do people start to ignore inflation? And the answer from securities markets and from the correlation of stocks and bonds is about 3%. So investing in an inflationary environment when inflation is at 4 is riskier. Because not only is it riskier for each individual security, but the correlation of those securities tends to go up, even stocks versus bonds. And because investing is riskier, that means less capital is available to businesses to expand. So it's worse overall for the economy. And we knew that. Businesses are impacted in other ways. Those long-term contracts tend to get much shorter, or they have to be renegotiated more frequently, or there has to be some sort of inflation adjustment, which still leads to jitter and renegotiation. I'll tend to hold more inventory. I'll tend to consume more capital. So you can see that less capital is available because it's riskier for investors. And businesses want to consume more capital because they want to hold more inventory and other sorts of things, which means that inflation goes up, so do real yields because the demand for money goes up and the supply of money goes down. So when inflation goes up, your nominal yields go up, both because of the inflation compensation and because real yields go up. So real yields and inflation are correlated, at least for a while as inflation is going higher. Not 100% correlated, but highly correlated. Long-term projects tend to get much more difficult. Something which looks like a positive NPV project today may or may not end up being profitable because the costs and the revenues will all change on the basis of the price level. So such projects need to be inflation hedged, or more usually, the hurdle to start the project is higher. The project needs to be profitable, but also profitable enough, with enough of a margin so that it'll probably still be profitable even if inflation turns out the wrong way. I'm assuming a certain sales price for my goods, and if it turns out that the sales price is lower, I still want this project to be profitable, or I've built this plant for no reason. Businesses will start using LIFO to value inventories, last in, first out. That has the tendency that they do that because while it reduces their earnings, it also reduces their tax burden. But that also makes analyzing businesses more difficult because when you look at the inventory account, it's a little harder to figure out exactly what that inventory is actually worth. Long-term care insurance, any long-term insurance becomes more scarce when inflation goes up. There's a reason that auto rates change so much, and that's because the price to replace a car varies so much. In the early 1980s, granted with higher inflation than 4%, but in the early 1980s, there were a number of insurance companies that were technically insolvent because of all the inflation risks that had turned out poorly, and because of their investment portfolios did poorly in exactly that case. Nowadays, there are better ways to hedge inflation, but insurance companies still don't hedge it. They try to underwrite better. They try to assume higher inflation and get away with it. But that still means they have more risk from any given retained book of business, and that means that insurance is less efficient at higher inflation than it would otherwise be. Now, as an employee, I have to argue with my employer about not only the merit portion of my raise, but also the cost of living adjustment part. Why am I using a national average CPI for my cost of living adjustment when the cost of my market basket is up more, or I perceive it to be more? I might need a union to protect my rights in this negotiation. Inflation makes all of these negotiations and agreements and society itself more fractious. In case you didn't notice, our society is getting more fractious, and at least some of that is because inflation is pissing everybody off. And it means we have to argue and negotiate about things that we didn't have to fight very hard about in the past. And the government gets a nice, juicy increase in its revenues and doesn't even have to ask us for it. So does all this happen at the line between 2% and 4%? Is it higher? Is it lower? I think there's a lot of evidence, and I mentioned some of it from markets and correlations, that 3%-ish is where people start to care. So inflation in the high 3s, low 4s, which is where I've said for a long time, I think is where we're settling in, is a problem. And that movement from 2% to 4% probably matters more than the move from 4% to 8%, because once you've adapted your society for inflation, the way you contract, the way you shop, the way you negotiate, the way you budget for the future, the way you save, how manufacturers mark up products right away rather than absorbing small costs, the way menus move to being on iPads instead of being printed. Those adaptations work just as well when inflation is 8% as when inflation is at 4%. Once you've made that movement, then it's painful to transition there to creating the structures in your society that make you inflation, adapting, right? That all those structures that now have to respond to the fact that prices are changing. It's painful to get to that transition, but once you've adapted, then it's okay. Brazil has had inflation between 2 and 17% for a quarter century before COVID. And it worked. It's a different society. They have different problems, different ways of dealing with things, but they manage, right? We had inflation below 2% or 2% or below for a quarter century, and the shift from 2% to 4% has been painful, and that's also a reason that inflation doesn't easily shift back to 2% once society has adapted to those higher levels. And that's because we've changed all those things. We've changed all those structures and all those ways. We've changed our methodologies to adapt to inflation. We've changed to using LIFO for our inventory, and changing back is a pain in the ass. Okay, so once you've started making those changes, then you tend to stay. You've sort of reinforced the institution of inflation. That's why it was so important to get inflation rapidly back to 2% once the COVID policy errors unleashed it. And then once it was really obvious that there were some big policy errors and inflation was going up hard, the right time to address that was right when you noticed it, not 3 years later. And because it took so long, society started to adapt. Society has adapted in lots of ways to a world in which inflation is now in the 4s, high 3s, low 4s. And so we're probably in a world now with a higher equilibrium than we had. And it's also a world with less stable inflation because those automatic stabilizers that tend to exist in a stable prices country aren't there as much when you're no longer a stable prices country. So I guess what I'm saying is defend your money. And that's all for today's podcast. Please like, subscribe, refer others. I like this. I think I like this episode. Send it around. You can contact me with comments or questions. inflationguy@enduringinvestments.com. You can subscribe for free to the blog at inflationguy.blog. And you should visit Enduring Investments if you are a business or a person, and any of the things that I talked about today make you say, hey, I think I need help to adapt to this new world. But most importantly, as I said, defend your money. And if inflation is coming for you, you should remember, you know a guy.